You should own more stocks in retirement, says Morningstar. What? So Sue sent this to me. And by the way, this is Rumble exclusive. I did this on the live stream. We talked about this, but I want to do a separate video solely for this. Rumble exclusive. So I appreciate y'all being on Rumble. If you're not subscribed to my email list, I'm not sure how to do that on Rumble. I got to put it in the feed here. It's on the show notes, so you can subscribe to my email list and my locals channel too, which you can see a little button up there that says subscribe to locals right there on all the videos I do. This right here is freaking annoying to me. From finance. Can I do my video? From finance.yahoo.com. Patrick Villanova, the Villanova Wildcats, writes this. Retired? You may want stocks, not bonds, to power your portfolio, to power it. And we'll see this. Look at the happy people. They have more stocks and bonds, and they're watching the grandkids. Isn't that great? If you're already retired, it may be time to rethink the role that stocks and bonds play in your portfolio, says John Reckenthaler from Morningstar. He examined market data for the last 80 plus years, essentially went back to 1930, and determined that portfolios heavily weighted in equities allow retirees to safely withdraw more money each year than those with large bond allocations. Stock-heavy portfolios, meanwhile, led to more capital appreciation than moderate and conservative portfolios. All right, so I want to go into this, and no one should ever buy a bond thinking they're going to get appreciation. Bonds don't appreciate. It's just that simple. A bond is issued at a par, and we usually say it in par is 1,000. A bond matures at par, 1,000. That's it. There is no appreciation. You have income, a 4% coupon. That is all you're getting. You're not getting any appreciation. You're getting income. That's why that's taxed as ordinary income. Appreciation is taxed as long-term capital gain. You're not getting appreciation. This is it. The only thing you can get on an appreciation or depreciation, a declining value, is a loss, i.e. the bond goes bankrupt. This is it, man. There's no appreciation in bonds. No one should ever buy a bond thinking they're going to get appreciation. Now, what people will do is they'll say, but Josh, I bought a bond. I could buy a bond today for 800. All right. So what they'll say is I can buy a bond for 800. It will go to 1,000, and that's appreciation. No, the only reason you're buying a bond for 800, which will appreciate at par at 1,000. So basically, you're buying a 20% discount. You're buying it at 20% discount. So the bond was issued at 1,000. It matures at 1,000. The only reason the price is at 800 now is because interest rates went up. Interest rates went up for other bonds being issued. So let me show you what I'm talking about. This is critical important, man. So we have two bonds. One's issued at 4% coupon at 1,000, and it matures at 1,000. One's issued at 5% coupon at 1,000, and matures at 1,000. We'll say everything's the same credit quality, everything's the same for simplicity. Only a fool would pay the same price for this than that. No one's going to do that. All right, so we know that the one paying 5%, we're having a current yield of 5%. That's what we have. We have a current yield of 5%. We have the coupon over the price equals current yield. And that's how you get your coupon. 5 over 1,000 equals your current yield. Or you could do it like this. Coupon over price equals current yield. I haven't done this in a long time. I think I got my Series 7 in 1999 or 2000. It's been a long time since I do this. But coupon over price equals current yield. So we know in this case the bond is paying 5% as a current yield. Well, this right here only has a 4% bond. No one's going to buy that. So what they have to do is we have to reduce the price in order to get the 5% current yield. And what we do is we say, remember, coupon over price equals current yield. So here we go. We know the coupon's 4, and we know the current yield is going to be 5 because they're going to be the same. If the exact same bond in terms of same maturity, same credit rating and everything, we know the current yield will be 5. So in this case, we do 4 over X equals 5. So 4 over x equals 5. And the reason is because we know for a fact that we're going to have a current yield of 5% to compete with the other bond at 5%. And 4 over x equals 5, which simply means x equals 4 over 5, or 80. That's 80%. All right, so basically the current price of the 4% bond will be 80% of the 5% bond. That's how you get this. So $800 at a 4% coupon equals a 5% current yield. All right, $800 price at a 4% coupon equals a 5% current yield. There is no appreciation. There's none. I hope that makes sense. I know that's a lot of divergence there, but the idea of buying a bond for appreciation is silly. But if I buy a bond mutual fund, what do you think bond mutual funds do? They buy individual bonds. All right, so you never buy bonds for appreciation. You buy bonds for income and safety. That's it. All right. History's lesson is straightforward. The more stocks, the merrier. Investing entirely in equities consistently generated either the highest safe spending rate for a given 30-year period or a rate that wasn't far off the mark. What's more, all equity portfolios were much likelier to deliver a happy surprise than to disappoint. Okay. Various rules of thumb dictates that investors should reduce risk in their portfolios and near retirement by reducing exposure to equities and having more exposure to bonds. For example, a 60-40 rule suggests a retiree should be 60% stocks, 40% bonds. Okay, 100%. Because preserving spending power is often more important for retirees than growth, appreciation, bonds tend to play a significant role in many retirees' strategies. Yes, 100%. But the guy from Morningstar eschews a conventional wisdom and argues that equity-dominated portfolios are better because he used historical data. He calculated the safe withdrawal rates of 3 different asset allocations: 100% stocks, 50 stocks, 40 bonds, 10 cash, and 90% bonds and 10% cash. I'm not sure who's going to argue that a retiree should have 90% bonds and 10% cash, but either way. Been conducting 1,000 different simulations for each asset allocation, and again using the 30-year rolling periods from 1930 to 2019. How many statistical relevant 30-year rolling periods do we get in that time frame? You want to take a guess? You had 2. 1930 to 1959, 1960 to 1999, and 2000 to 2021. You only had 2 statistically relevant 30-year periods. That's it. All the other ones are intertwined. 1930 to 1959 is over 95%. The similar is 1931 to 1960, which is over 95% similar to 1932 over 1961. It's just not statistically relevant because there's too much overlapping there. So we only have 2 30-year periods. That's it, of any statistical relevance. That's just not a big enough sample size to say there's any validity to this whatsoever. But he does, and even worse so, he's going to say, look, but I did 1,000 simulations, all right? You did 1,000 simulations on basically 2 30-year rolls, time periods, and 1 21-year time period. That's it. So you have, we'll just say for simplicity, 3 time periods, all right? And how do we figure out standard deviation? Well, we have 3 time periods. That's it. So we figure out average returns, which over those 3 time periods, hold on a second, which give us, so remember, statistical analysis in Monte Carlo scenarios is we have average returns and we have standard deviations, volatility. Well, you have 3 time periods. And actually, only 2 are 30 years, so it's not statistically relevant. You can still have a standard deviation and an average return. You can run all kinds of different scenarios based on that, but still based on insignificant time periods. It's just not enough data to make any thought of this at all. But people do this in my business all the time, drives up the wall. So it's irrelevant, but we'll see what he says. He defined a safe withdrawal rate as the highest amount that can be removed for all 30 years. All right. In other words, despite containing more risk with stocks, well, did you have more risk with stocks from 1930 to 1960, well, 1959, and 1960 to 1999? I mean, there's risk in there for sure, but did you have actually more risk in those 2 time periods? I mean, it's completely random, man. There's no way to use that information going forward. It's silly to do that. He found, I mean, if you're going to do that, why would you not do it with Japan? Why would you not do it with Russia stocks? I mean, you can't pick and choose the data sets you want to use unless you're just, I don't know, I just ignorant. I don't know what else to put it. I'm not trying to bash this guy, but it's like, all right, we're going to use American data set. We only have two sample sizes. And we're going to use America. Okay, so we're really narrowing very much. It's just statistically irrelevant. He found the equity portfolios would have resulted in leftover assets after 30 years of withdrawals with each period. Retirees used the most conservative allocation would have run out of money during three different 30-year periods in the 20th century. Okay, well, if we had 33 different 30-year periods and with 1,000 simulations, that doesn't seem that bad to me. At the point, let's see if we got any comments on here. All right. Should the future resemble the past, the lesson remains valid. Retirees should invest heavily in equities, most likely more than they currently do. I just, and this guy says, quite an assumption that bonds are always less risky. They are always less risky. I mean, a bond is inherently less risky, simply because a bond is guaranteed to mature at par. Stocks are not. Now, if bond goes bankrupt, is just as risky as the stock. But then again, the stock doesn't have to pay a dividend, and generally speaking, the bond's interest income will be higher than a stock's dividend either. Anyway, so if the bond goes bankrupt, the stock's going bankrupt too, and you got higher income from the bond. This right here is Snake Pliskin is saying, I'm retiring, doing a lot of research on how best to invest my savings. Don't listen. Okay. And this guy's saying do business development companies. Oh, jeez, man, it's bad. All right. Anyway, the point being is this is silly. And not only that, you got to remember what happened in the late after the Great Depression. So the whole world was essentially in a depression of the 1930s. The 1940s, the world was in a chaos of World War II. Then we were the only game in town from basically 1940 till essentially Japan, Taiwan, South Korea. Then China jumped on for the globalist cabal that came down through Nixon and Kissinger and whatnot. And then China jumped on in the 80s when they said to be rich is to be to glorify, to be rich or something like that. To be rich is to be, I can't remember what he said, the guy, the premier of China after Mao. Anyway, the point being is then we had globalization. So we had the American was the only game in town. Rebuild Europe, rebuild Japan, the whole thing. South Korea. We were the only game. All right. And then after that, we expanded to cheap labor overseas. Well, those days are gone. It doesn't mean it's not going to happen again. It just means the idea that this tiny period of American history is warranted that you should base your retirement portfolio on that is on a 2 times 30-year periods is just don't do it, man. I'm not saying, look, you can do whatever you want, but the idea that there's some legitimacy of this is not good. All right, love to hear your thoughts. Thanks again for being here on Rumble. We'll see you guys.